Wealth creation is within reach. In today's video, I'm going to focus on my most passionate topic. I love to talk about wealthy children. Any parent who is watching me today, this is your video. I'm going to show you 3 strategies you can use to create wealth for your children in Canada. So, when it comes to wealth creation, specifically for Canadians, we have what we call Registered Education Saving Plan. That's called RESP. Now, majority of people have opened that, but the question is, do you really understand how it works properly? Properly is the what? So if you have children, who are under 17 years old in Canada and you get child tax benefit, the government has blessed you with an opportunity to give you something every single month to plan for your children's future. The question is, are you doing your due diligence to understand how you can start creating wealth with that? So let's look at this first strategy. Registered Education Saving Plan is a plan set up by the government to help you structure a financial future for your child's education specifically. When you open this account, there's some grants you get. There's a $500 grant, which is one time. There's a 20% grant every single year that comes depending on how much you save until your child is 18 years. Remember that grant that comes every year or every month based on how you save has a cap on it. You can only save $2,500 a year if you want those funds to be matched up to 20%. That does not mean that you can't save more money. You can, but the matching will only happen up to $2,500 a year. So that's around $208 some cents every single month per child. When you talk about RESP, we talk about 3 types of RESP. 2 types of RESP actually. We have group RESP if you have your employer who has a plan that we call group plans, group RESP for your kids, then that's a benefit that you can tap into, right? And then we have what we call self-directed RESP, which you yourself open with any financial institution. It could be a bank or it could be an insurance company, right? The rules are the same, whether you open it in the bank or you open it with an insurance company. The only difference between these two is where the money is invested, right? They could be GICs, guaranteed investment certificates, it could be mutual funds, or it could be seg funds. So I want you to take your time and learn more about GICs, mutual funds, and seg funds so that you see which one suits your children's education planning. Now, if you do it properly, you could potentially get a good return over time. Remember, if you start planning when your child is still young, you can set up your child for a very successful future, okay? Now, what are the things that you need to understand about RESP, right? When it's properly invested, it encourages you to save, because if you're getting some grants, some matching, then it motivates you to save money. There's wide investment options you can choose from, and you can transfer your contribution to the next child in case your child decides otherwise. But these grants have, this particular account has also its own limitation. Some of the things you need to understand is this account is specifically meant for education purposes. So if your child decides otherwise, they're not going to school, then the grants that came from the government need to go back with the interest those grants produced. Therefore, your money that you contributed can be rolled over to another child, but grants are not transferable. The maximum grants per child is around $7,200. So remember that. You can save that, but this account is specifically meant for education. Now, the second strategy you can use is when we call whole life. when you're using an insurance product to set up your child for a successful future. This is not for education. This is insurance for your children. I have to be very clear. Insurance for your children, you can call it whatever you want to call it. I'm giving my children a gift for their entire life. That's one thing you can call it. I'm creating generational wealth for my children because your children will benefit from it. Your grandchildren and great-grandchildren will benefit from it as well. So you're actually creating the lifestyle for your children using a life insurance product. The benefits of doing that is your child is protected from day one. People always come back to tell me, I do want to have a life insurance for my child because I don't want my child to die. Nobody's telling you that they want their children to be dead. But we're trying to help you understand wealth creation. When started at an early age, it creates generational wealth. And the good news is you're not doing it with your money. You have some child benefit you get. Why can't we put it to work for your child's future, right? When you're using a whole life, you can also have some savings within that plan. So when I talk about having some savings in that plan, what do I mean? I mean, if you're putting in money in a participating whole life, dividends are getting paid every year. Even though the dividends are not guaranteed, they are paid out. So that means you've bought life insurance on your child's life from the young age, and the child will never have to go through that process again. Now, while the plan is growing, the cash value in the plan is growing. That cash value you're growing in the plan, my friends, you can use it for anything. Whether you want to supplement for your child's education, the RESP is not enough, you can use it. You want to buy your child a car after they turn 18, you can do that. You want to start a business for yourself or your child, you can use that money for that. You can create a pension for your child's future using that money, or you can use that money for whatever thing you want to use it for. The good news is when you leverage that plan, it still creates generation. So as much as your child will use that in their pension life, there will still be death benefit that will be transferred to their next generation. How would you feel today if I come to your house and say, Esther, you're 35 years old, your mom started for you a whole life when you are 15 days, and now you have $120,000 saved in this plan. Here is a check, go buy a house. How does it make you feel? That expression in your face is exactly the same expression you're putting in your child's face. When you start this, today, you can decide to start where you are, to create a safety net for yourself, for your children, and generations to come. The cash accessible is accessible in a tax-efficient way. Again, you have to design it properly. It is a long-term plan. The reason why I'm talking about wealth creation, I'm looking at 18, 20 years from now. If you're thinking your child is 1 day old, when they turn 15 days, you can get this plan set up. Let's say you set up a plan for $200. I'm just giving an example. Now, if you decide to put $200 every single month for the next 20 years, how much would you have put in 20 years? Maybe around $48,000. Now, let's say that child is 18 years old, and now they have over $370,000 worth of life protection. That is not enough. They still have some cash of over $40,000 they can access. I'm giving an example of a 1-year-old who is starting with $200 and they're saving it for 20 years. And when they're age 67 or 65, they have almost $800,000. Think about it. You saved around 48,000 in a plan that over years it compounded with rule of 72. And now you're creating over 800,000 pension, tax-free. Plus, you have over 1.7 million worth of protection for your child's future. How does it make you feel that your child will buy a house and they will never worry about mortgage insurance? Your child will do their wedding and they don't have to worry about the budget. Your child will need a car and they will never have to worry about where will the money come from. That is the benefit you get from this. The last strategy I want to talk about is critical illness. When I talk about critical illness, to children, it happens as well. Remember, critical illness pays a lump sum. So it pays a lump sum in case a child is sick. The policy covers some critical illness that are not covered by adults. For example, diabetes type 1 is a critical illness to a child, but it's not a critical illness to an adult. So you need to make sure that you have something in place. Now, people tell me, my child is too young to get critical illness. So if they never get critical illness, can I get the money I paid back? Yes, we have strategies in place. We can do that. We can create that critical illness for your children, pay it for next 10, 20, 15 years. If the child is never critically diagnosed, you get every dollar you put in. Is there a reason why we should not do that? Think about your child plays basketball, rugby, soccer, any kind of sport, gymnastic. Let's say they went for a gymnastic practice, and during the practice, the child hurts the spine, and the child is home. Yes, they will recover, but what does it mean to you and your spouse? That you cannot go to work, either both of you or one of you. So your income is crippled during your child's illness. It was an accident that has led into a critical injury. My friends, think about the love we have for our children. We love them to play hockey. How about if they get brain concussion through the field? What does that mean to you as a parent? That's why we put these strategies in place. Remember, I spoke about blueprint. Financial blueprint is protecting the income. When you're doing critical illness protection, your child is not the beneficiary, it's the parent, because the child is underage. So in that circumstance, the parent is trying to protect their income while raising their children, so that in case something happens to their children, accidentally or through illness, they don't have to worry about their income getting affected. Transferring the risk. You sustain the wealth. You don't have that disruption. You deal with the illness and realizing that, God forbid it happened, I can focus on my child's illness, I can seek medical attention, and I have the funds to take care of that. That's why we want to create wealth to our children. Again, in summary, I give you 3 strategies. Registered education plan, specifically for education. Whole life, specifically life protection, but the cash value can be used for anything. It's not specific. And then the last thing I talk about is critical illness. Again, remember, wealth creation is within the reach, but only for those who take action. If you enjoyed watching this video and you love what you're listening to, like the video and share it with your family and friends. The details of our contact is in the description below. Share it as well. Reach out so that we can start creating that wealth for your children. We need wealthy children. See you in the next video. Thank you.